Hey everyone, welcome back to Corporate Decoder, the place where we break down the confusing world of corporate finance and leave you questioning if these companies are actually good at what they do. Today we are diving deep into Ingersoll Rand Inc.'s latest quarterly report, and let me tell you, there are some interesting numbers hiding in here about their acquisitions and their financial health. And before we jump in, if you appreciate getting straight insights from corporate documents like this, make sure you are subscribed. We also have a Discord community linked in the description below where we break down these reports in real time and answer all your questions. Alright, so Ingersoll Rand Inc. These guys are a big deal in flow creation products and industrial solutions. Think pumps, compressors, all that stuff that keeps industries moving. They just dropped their quarterly report for the period ending the 30th of September 2025, and we are going to dissect it. Let's start with the top line revenues. For the 3 months ending the 30th of September 2025, revenues hit $1.955 billion. That is up from $1.861 billion in the same period last year. So that is a solid increase of about 5%. Well, a big chunk comes from acquisitions that added an extra $88.3 million. They also saw higher pricing contributing another $49.4 million, and a nice boost from currency exchange rates adding $30 million. But here is a kicker: organic volumes, the actual amount of stuff they sold beyond acquisitions and price hikes, actually went down by $73.7 million. So they're selling less product naturally, but making more money by charging more and buying other companies. For the 9-month period, revenues are also up to $5.559 billion from $5.336 billion last year. Again, acquisitions are a big driver here, adding a massive $344 million to the top line. Moving on to gross profit, this is the money left over after they pay for the stuff they sell. For the third quarter of 2025, gross profit was $855.2 million, up from $815 million last year. That is a 4.9% increase, which is pretty much in line with their revenue growth. However, when you look at it as a percentage of revenue, it stayed almost exactly the same at around 43.7%. They say this is mainly due to acquisitions, but also because they had to increase prices to offset rising costs from tariffs. So while they are making more gross profit, it is not because they're selling more organically, but more because they are strategically growing and adjusting their prices. Now let's talk about selling and administrative expenses. This covers things like marketing and management salaries. For the 3 months ending the 30th of September 2025, these costs rose to $361 million from $334.3 million last year. That is an 8% jump. Again, acquisitions are playing a role here, but also, and this is important, these expenses as a percentage of revenue also increased from 18% to 18.5%. This means that for every dollar of revenue they brought in, they spent a little bit more on selling and administration. For the 9-month period, this increase is even more noticeable, going up by almost 7% to $1.082 billion. This rise as a percentage of revenue is mostly because their organic sales volumes are lower. Next up is the amortization of intangible assets. These are basically the cost of things like patents and customer lists from past acquisitions spread out over time. This number stayed pretty steady at around $94.9 million for the quarter and $277.8 million for the 9-month period. It is a big number, but it is not changing drastically period to period. Now this is where things get really interesting. In the second quarter of 2025, Ingersoll Rand took a huge hit with impairments. They wrote down their goodwill by $229.7 million and other intangible assets by $36.1 million. That is over $265 million in value just gone. They say this was due to organizational changes within their precision and science technologies segment. Specifically, 2 major acquisitions from ILC Dover, their biopharma and aerospace and defense businesses, had their goodwill values slashed. The biopharma business took a $170.3 million hit because of higher borrowing costs and market multiples shrinking, and the aerospace and defense business lost $59.4 million because their long-term forecasts were reduced due to a significant customer's decreased business. This is a major red flag. It means that the value they thought they were getting from those acquisitions vanished quite quickly. This also impacted a trade name they acquired for $36.1 million. This is a serious reduction in asset value which directly impacts their balance sheet. Let's touch on other operating expense net. For the third quarter of 2025, this was $23.8 million. This is down from $29.4 million last year, mostly because they had fewer acquisition-related costs and lower currency losses. However, for the 9-month period, it really dropped from $942.8 million last year to just $65.4 million this year. This huge drop is mainly because last year they had a massive $58.8 million loss from selling off their asbestos business, so while this expense line looks much better this year, it is largely due to a one-off negative event last year. Interest expense is up. For the 3-month period, it was $65.1 million compared to $63.8 million last year. For the 9-month period, it jumped significantly to $189 million from $151.4 million. This is mostly because they took on more debt, especially to fund that big ELC Dover acquisition, and interest rates have been higher. This higher interest expense eats into their profits. And then there is the loss on equity method investments. For the 9-month period ended the 30th of September 2025, they reported a loss of $127.1 million. Last year for the same period, it was only $19 million. They mentioned they previously sold most of their high-pressure solutions business but kept a stake. It seems that stake has lost a significant amount of value and they took a big impairment charge. This hit their net income hard for the 9-month period. Let's look at net income. For the third quarter of 2025, net income was $245.8 million, which is up from $223.4 million last year. That sounds good, right? But when you look at the 9-month period, net income plummeted from $614.4 million last year to just $320.4 million this year. This massive drop is directly tied to those goodwill and intangible asset impairments, and that equity investment loss we just talked about. So, while the quarterly result looks okay, the year-to-date picture is much less rosy. We always like to look at adjusted EBITDA because it can give a clearer picture of operational performance by excluding some of those one-off items. For the 3 months ended the 30th of September 2025, adjusted EBITDA was $544.6 million, a slight increase from $532.7 million last year. However, as a percentage of revenue, it actually went down for the 9-month period. Adjusted EBITDA actually nudged up to $1.513 billion from $1.485 billion. But again, as a percentage of revenue, it declined. The reasons listed are pretty consistent: lower organic sales volume, unfavorable costs and product mix, and the dilutive impact of acquisitions. So even though they are growing through buying other companies, the underlying operational efficiency seems to be facing headwinds. Let's break down their segments. The Industrial Technologies and Services segment saw its orders increase by 7.2% for the third quarter. Revenues here also grew by 5%, but their adjusted EBITDA actually dipped slightly by 0.5%. This means that while they are getting more orders and bringing in more revenue, their profitability from operations in this segment is struggling a bit. For the 9-month period, orders are up 6.7% and revenues are up 1.8%, but segment adjusted EBITDA is down 2.6%. The Precision and Science Technologies segment shows a stronger picture in the short term. Segment orders grew by over 11% for the quarter and revenues were up 5.3%. Most importantly, their segment adjusted EBITDA increased by 8% and the margin actually improved. For the 9-month period, orders are up a whopping 16.9% and revenues are up 14.2%. Segment adjusted EBITDA also saw a healthy increase of 12.4%. This segment seems to be performing quite well. Now let's talk about cash. Cash provided by operating activities decreased slightly for the 9-month period to $856.7 million from $870.5 million last year. This is attributed to more cash being tied up in working capital, higher interest payments, and more pension contributions. Investing activities really paint a picture of their growth strategy. They spent $98.1 million on capital expenditures for the 9-month period. That is normal, but then they spent a staggering $459.8 million on acquisitions in 2025. Now compare that to last year's 9-month period where they spent a massive $2.87 billion on investing activities. A huge chunk of that was acquisitions, specifically that ELC Dover acquisition costing almost $2.4 billion. So they clearly made some big moves last year. Financing activities show some pretty significant moves too. For the 9 months of 2025, they used $726.6 million mainly to buy back their own stock. They also paid out $24 million in dividends. For the 9 months of 2024, it was a very different picture. They actually brought in $1.782 billion. This was largely due to taking on new debt, specifically about $3.3 billion in senior notes. They then used some of that to pay down other debt. Free cash flow, which is cash from operations minus capital expenditures, remained pretty stable at around $758.6 million for the 9-month period in 2025, compared to $756.7 million in 2024. This is a positive sign that despite all the acquisitions and debt, they are still generating good cash from their core business to cover their investments. Looking at their working capital, it decreased slightly. This means they have a little less quick cash on hand relative to their short-term obligations. They say this is due to higher inventories, higher accounts receivable, and lower accounts payable. So they're holding more stock, customers owe them more money, and they are paying their suppliers faster. It is a delicate balance. And this dip in working capital combined with rising interest expenses means they need to keep a close eye on their cash flow. Now, for my take on all this, Ingersoll Rand is definitely in a growth phase, aggressively acquiring companies to expand their reach, especially in that precision and science technologies segment. That segment is showing solid gains. However, the massive goodwill and intangible asset impairments totaling over $265 million in the second quarter are a serious concern. It suggests that they overpaid for some of those acquisitions, or that the market conditions changed so rapidly that the value they expected just isn't there. This is a classic example of the risks involved in aggressive M&A. The significant loss on their equity method investment is another warning sign indicating that a previously held stake has taken a substantial hit in value. While they are generating positive free cash flow and their credit lines are available, the increase in debt and interest expenses coupled with these impairments highlights the financial strain these growth strategies can put on a company. They're growing, but it is coming at a cost, and they need to show that these acquisitions will eventually deliver the projected synergies and profitability. The market will be watching closely to see if they can manage these new assets effectively and integrate them without further significant write-downs. Alright, that is our breakdown of Ingersoll Rand's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps. And subscribe for more deep dives into corporate filings. And don't forget to check out the Discord in the description for more in-depth discussions. Thanks for watching. See you next time.